what I want to do today, it's our second class. It's a really, really important one because we're going to be getting into that massive exam one question. You want to be preparing for that. It's the only thing you have in this class until next Friday when we get the employment report. So you really want to be writing that exam answer as we go. The students that really bomb that exam questions are the ones who are just kind of halfway listening in class and then try to throw something together right before the exam. It just doesn't work. This is something you want to move to your permanent memory. I'm giving you a template here that I think is really quite valuable. So what we want to do is we'll talk about the markets today, which were really, really interesting markets today, no question. See if you guys can talk about it. And then we'll get into question one. I'll walk you through that. So before we do that, I want to show you something that you should do. So let's say you have an interview today. There's three things. If you had an interview today, there's three things you would want to know walking into the interview. If you are a finance person, you're interviewing for a finance job, these are three things that you better know, all right? So I built a spreadsheet that you can build yourself. So what I did is in this first spreadsheet, I brought in the historical data for the 1-year treasury and the 10-year treasury. Now, I'd rather would have brought in the 2-year treasury, and I'll tell you that why that's the case here in a second. But the 2-year treasury doesn't go back to 1962. So the 1-year does, so I did that. So I brought in the 10-year treasury and the 1-year treasury. Where did I get that? If you go into Google, all you have to type H15. You type H15. I don't know why. I don't know what that stands for, but it brings up the St. Louis Fed. And they have a button where you can click, brings historical interest rates in. They have a button where you can click the download. And when you do that, you'll get all this data. Now, they actually gave me the 1 month, 3 month, 6 month, 1 year, 2 year, 5 year, 7 year, 10 year, the entire yield, what we call the yield curve. Y'all remember that from your 3013 class, yield curve? Anybody know what the yield curve is? Any takers on that question? I know someone knows it, and they're just, y'all are a lot shyer on Zoom than you are in the classroom. I'd be really, really upset if not a single person in this class knows what the yield curve is.
It's the correlation between how far out a treasury is compared to the yield that that corresponds with it.
Yeah, very good, Thomas. So it's yields by maturity. Right. So as you said, the word correlate, or you match the yield and maturity. So that's the yield curve. I guess I should be more precise and say it's a treasury yield curve. There are other yield curves out there. There's a swaps curve, there's corporate spread curve, but the yield curve. So Michael, what did they tell you is norm? Longer rates are usually what versus shorter rates? Usually higher or lower than shorter rates? Do you remember that?
Longer rates are typically higher.
Higher. So the yield curve is upwardly sloping. So that's a really important one, especially right now, because what do you get? What's the number one recession signal out there? Anybody know that? What's the one thing, if you saw it, you say, wow, we're going to have a recession next year?
Inverted curve.
Inverted, very good. Well, you had a good 3013 or whatever class you got all that in, Michael. Very good. Inverted yield curve. So when long-term rates are shorter than short-term, I usually look at it as the 10-year versus the 2-year. Sometimes people do 10 versus 1. The media, what does the press do? The press does whatever makes their story. So if the 10 is greater than the 2, but less than the 1, then they'll use the 10 and the 1. They'll use whatever they can find. I've seen them do the 5 versus the 1. Whatever they can get to say we're going into recession, because the market, the media loves that. the traditional I heard, and I have some pretty good sources here. There's a really good economist that teaches at UTSA. He talks about the 10 versus the 2. So I think that's the most normal one. I'm using the 10 versus the 1 here because I have more data. But the theory is if we're expecting a recession, the market is going to expect the Federal Reserve to cut interest rates, but they're going to cut short-term interest rates, but they haven't cut short-term interest rates yet. So short-term interest rates stay up until the Fed cuts, but the long-term rates, they're essentially estimating rates out the next 10 years. They drop, expecting the Fed to cut rates. And so the 10-year actually drops below the short-term rates until the Fed finally cuts rates, and then the short rates come down below. All right. So the question is, what's normal, what's steep, what's flat, and what's inverted? And so that's what you can do here. You can just bring these rates in. Now, one thing I have to warn you, when you bring this in from the Fed's site, for some reason, they bring in the holidays. And the holidays just say no data. So you do have to sort it, get all the no data out of there, and then resort it. That's what I did for you. I didn't want to waste your time on that. But July 4th, Christmas Day, New Year's Day, Thanksgiving, those are all going to have NDs in them. You just have to sort them down to the bottom, get rid of them. I already did that for you. So the other thing I did is I'm looking at the change in the 10-year. So right here, the 10-year rate went from 4.06% to 4.03%. So it dropped 3 basis points. All right. So if I go down to the bottom, there's 2 pieces of data that I would have. First is the 10-year Treasury minus the 1-year Treasury. And the average there is really easy to remember. It's almost exactly 1%. So the norm is for the 10-year to be 1% higher, 100 basis points higher. So if the 1 year is at 2%, you would expect the 10-year to be at 3. That's the norm. Now, people are talking about a recession right now, but is the yield curve inverted right now? The 10-year was 1.75% on Friday. The 1 year was 0.58, 117 basis points different. No, it's actually slightly higher than normal. And you can see it's been pretty steep. If you go back up, it's been pretty steep. Especially if you go back last year, we've had fairly steep yield curves. Another thing we can do the 10%, this 10% percentile and the 90th percentile. And y'all see how this would be really, really helpful in an interview. So if I do equal percentile and I do the difference between the 10 and the 1, okay, percentile. I don't know why. Oh, I got to tell it what I want to do. Sorry, comma 0.1. So at the bottom, they're doing the percentile for the bottom. So 10% of the time, the yield curve is actually negative 27. And the 90th percent for a steep yield curve, it's 250. So you might just memorize average is 100 basis points. Flat is 0. Negative is, it's not that negative. It doesn't get down. I don't know how far down we can get here. And yeah, in an extreme case, like in the 80s, we had some really, really extreme yield curves back then. So, it can, but 10%, 25 basis points negative. It doesn't have to be that negative. I generally think if it gets to like negative 50, that's a pretty sure sign we're going to have a recession. All right. And then steep is 250. So just memorize 250. I mean, it's 258, but 90% of the time it's 250 basis points or less steep. So 250 be really steep. So what do we have right now? You go into an interview and your interviewer says, hey, what's the 10-year Treasury telling you? You say, well, people are talking about recession, but the yield curves, the 10 years, 117 basis points above the 1. That's a pretty normal yield curve. 100 is the norm. The Treasury curve is not telling us we're having a recession. It's also not expecting strong economic growth. It's not particularly strong. It's pretty normal. So right now the yield curve's not telling us much. All right, y'all see how that would be. I mean, if they asked you that question, you probably would have just given them the best answer of the day. All right. What about the change in the 10-year? Y'all saw last Friday, we had a really huge change in the 10-year. It dropped 8 basis points. What does that mean 10-year treasury prices did? So I'll help you here. The 10-year treasury, what word do we use? At a what? A weak rally, an average rally, slightly up, strong rally?
Strong rally.
Strong rally, yeah. As yields dropped 8 bips to a closing yield of 1.75%. And that's not how you spell yield, but I can't type. All right, so Friday, if you had to interview for a job on Friday and they asked you about interest rates, so wow, Treasury's really rallied today. So you would have, I assure you, you know something that basic. So here's 3 things going into interview. How steep was the yield curve going to yield curve in your interview? Right now, it's pretty normal. It actually flattened on Friday. Y'all can see how it flattened. Y'all see that? It went from a difference of 123 basis points to 117. So the yield curve actually flattened a little bit, but it's still at a normal level. So the yield curve's not really telling us recession or strong growth. It's just saying normal. However, the 10-year treasury rallied really strong on Friday, down 8 basis points, closing yield of 175. The other thing I did the standard deviation of that. And I told y'all that last class. It's about 6.5 basis points. That's why I say 8 basis points is a pretty big day. 1 standard deviation, that's a pretty big event, right? 67% of the time, you're between 1 standard deviation. So about 15% on the upside, 15% of the time on the downside, you get something bigger. So Friday was a pretty big day. We can do the min and the max here as well. So you can see last Friday was actually a pretty big day. 90% of the time, the yield does not fall more than 7 basis points. What did it do on Friday? It fell 8. So Friday was a big day for the Treasury market. Okay. And then the max is 7. So 90% of the time, not the max, but 90%. So you see, last week was a big week for Treasuries. When did Treasuries move a bunch? Well, when you're talking about recession or you're talking about inflation, that's what moves Treasuries. Treasuries love recessions. If you think there's going to be a recession, yields fall. Treasuries hate inflation. If you're worried about inflation, yields rise. Now, I'm telling you stuff you had in 3013 and in your macroeconomics class, but it's important to this first paper because you're going to be talking about what's going on. Any question on Treasuries? Know the steepness, know the change, and know how to compare it to history. All right, just that little thing I just told you gonna put you ahead of 99% of students interviewing for jobs. Same thing on the stock market. So here's the S&P 500. It closed at 4410 today. I'm gonna do the change of the Treasury. I mean the S&P 500. So today it was up 0.28%. Anything that you'd want to add to the day? No, Juan Carlos, you said no. If the difference, if the 10 minus the 1 is more than 250, that would be strong economic growth or strong fears about inflation. So if the 10 years 250 basis points above the 1 year, the market's saying everything's going hot. Maybe too hot. Maybe it's inflation. All right, Juan Carlos, that answer your question, hopefully. So what was the big news today? Well, look at the minimum today. The market today was down. Whoa, I didn't see that today. Wow. The market was down 4% today at its low. Could you go into an interview and not know that? That would be really bad, wouldn't it? If you go in an interview and they say, what do you think about the market today? Oh, it's up 28.28%, not much of a day. They're going to be sitting waiting for you to say something else, aren't they? Because that's a huge day. So here, let's do the standard deviation of this. Now, I went back much further in history, so it might be higher than the 1% I told you, because I got some Great Depression in there. So that's probably a little bit much. Let me do it from 1970, because that's just too much. I can get back that far. Now, where did I get this? I got this out of Yahoo Finance. Yahoo Finance used to take the S&P just back to 1980. This morning, I pulled it through 1922 and it was still going, but I was running out of time, so I just stopped. I don't know how far back they go. You can find it back to 1871 on the internet for free. Which is a little strange because the S&P 500 didn't exist in the 50s. Standard & Poor's didn't exist. So whoever's giving you the Standard & Poor's back to 1922, they're guessing what would have been in the S&P 500 back then. Because today the S&P 500 is the committee at Standard & Poor's and they decide what's in the index. So it didn't really actually even exist. I don't know what year the S&P 500 started as an index. Sorry about that. It's a lot of years back there. 1970, getting close. So if you go back to 1970, it's closer to 1%. But just think in terms of the S&P 500, that 1% is a pretty big day for the S&P 500. Yeah, that's a good thing to look up. That's something you might look up. So Noah's saying for the S&P to be down 4% in a day and actually close up in 2008 makes sense, Noah, because boy, those days were really volatile back then. So something unusual happened today. You would not want to go into an interview and not know that. They would be pretty shocked, right? So it's not like you got to go into interview knowing 87 things. There's a small number of things, 4 or 5 things that you really want to know that's going on. One of them is your first paper. It's the jobs report. You want to know what's going on with the jobs report. So you want to know that, especially if it isn't anywhere close around your interview. But know where the markets are. So know where the 10-year is, know where it is versus the 1 year. Know what the basis points change was for the day, and then know how did the S&P move today and how volatile was it? Those kind of things. You look at last Friday. What kind of day was last Friday? What would we have said here? The S&P 500 sold off strongly, down 1.89% to close at 4397.97. Down, how many points is that? I don't know how many points that is. Let's see. Down 85 points. And you can word it better, not just the S&P was down 85 points, a strong sell-off of 1.9%, closing at 43.90. However you want to word it, there's different ways to word it. So if you look at Friday, the low on Friday is 43.95 and it closed at 43.97. So it closed pretty close to its low for the day. Today, it closed kind of close to its high for the day. So, we're not back up to where we were on Thursday. So one other thing you might want to do is get the max, the S&P 500. And that was 47.96. I don't know when we hit the max. You might want to know that. So we hit the max back on January 22nd. And as of Friday's close, as of Friday's close, we were, sorry, my computer did something strange. Because we're up today, so I want to know how much is the market down from its high. And so its high was 40, is that it? 46.9656. So the high is right there on January 26th. We're down 8% from that high. That would be something good to know. All right. So this is stuff to know, you know, they want to know, and here's what they're trying to do. This is what employers tell me all the time. They want to hire students that are really curious. If you come in with all this kind of random data that's really important, and you show that, hey, I'm following markets. This stuff's interesting to me. I'm really interested in what's going on. Boy, that separates you from the crowd. So this is the kind of stuff to know. There's probably more stuff out there that you should know besides this. You can probably get creative and find some other stuff. You don't want to get too esoteric and say, you know, well, silver prices were down, whatever today, you know, that gets a little too wild unless something major happened with gold prices or something. But definitely the S&P 500 is one you want to know. You might look at the Japanese market. You might look at what's going on in Europe. You know, there's other places to look at, like the FTSE and those kind of things. There are other markets to look at. You might have, and this is what I would call a dashboard. You might create your dashboard. So you collect about 10, 15 pieces of data, and then you start watching it every day. So when you get to the interview, it's not this crash memorization you're doing. You're doing this every day, so you just know. You know what markets are doing. You get used to it. You get into the terminology. You see articles. So you see Japan's down 8% on a day. You go, wow, what happened in Japan? What's going on there? Is that a carry trade unwinding? Did Japan get some bad inflation news? What's going on? You know, so, but if Japan's down 0.1%, you don't bring up Japan in your interview. All right. So
I had a question.
Okay.
What does it kind of like mean, like where the market was down almost pretty much 4%, but then closed above where it opened? Like what does that tell us?
I just got back from a bike ride when it happened, so I haven't been able to read any articles. I'm sure there's some good articles out there on, you know, MarketLine and on, Market Watch and Yahoo Finance. Yahoo Finance, let's say, stocks claw back losses. Investors looked ahead to a busy week of corporate earning results. Does Yahoo Finance know why that happened? Probably not. Someone's going to make some stuff up. Prices for major track expectation for tighter financial conditions that have Fed this year observed.
From what I read, it was stuff going down in the Ukraine. And like
so the
Russia.
Ukraine caused a sell-off. Did something happen to reverse that? Some new news on Ukraine? Did Putin say something? I got home from my bike ride and I also crashed on my bike ride and separated my shoulders. So I wasn't in the mood to watch markets today. So I got a couple different answers, one from Noah, one from Stepan. So nobody really knows. You try your best. I would look at Bloomberg. I would look at Market Watch. I would look at Yahoo Finance. Try to find people. Bloomberg itself, the Bloomberg machine. Noah or Eric, if you go on the Bloomberg machine, if you have an account, just go on the Bloomberg machine and type news or type AV or audio visual. And you'll see all kinds of stuff coming up, and it's pretty current. Bloomberg is really good at giving you a good scoop because they don't interview politicians or journalists. They're interviewing portfolio managers. So they're interviewing the right kind of people, and that's what you want to listen to. I used to do a lot of interviews for news articles, and they would call me and they already had my quote written out. And they would ask me, Ron, do you think this? If I said yes, that was my quote. If I said no, they hung up and called somebody else. So if you listen to journalists already have their articles written, so their quotes are not really true. You want to listen to people who are actually managing money, and that's what Bloomberg will bring to you. So yeah, if the Fed has a meeting today, we got all the earnings coming out today. Ukraine, I think, is a big one, no question. I don't think we got inflation news today, but next week you're getting an employment report, so that could be big. I'm hoping it's going to be big because you got to write your paper about it. But Eric, yeah, I don't know yet. I'll try to figure it out, but y'all try to figure it out as well. It does mean something, right? Not only did it come back, but it came back fast, really, like in the last hour, it looked like. I think it was down most of the day and it just really shot back. Anybody have any other comments?
So like if we were going into the interview, like because you said like knowing that would be pretty important to know in the interview. So like if we saw that, then we should figure out or just try to figure out why we think that was instead of just saying that and not really knowing anything about it.
Yeah, and if I were doing the interview, what I'd want to hear a student say is, yeah, I heard that Bill Gross said this and I agree with him. So it's two things. First, that you're entry level. They don't care as much about your opinion because they don't think you have enough experience yet. You may be the smartest person in the world, but they don't care yet. So they want to know you're out there reading other people's opinions, not that you have your own opinion. So Bill Gross said this, and I agree with him because that would be the perfect answer. Do we have any volunteers to tell me about the S&P 500?
I'd like to give it a shot.
All right, Eric.
So the S&P 500 was up 12.19 points to close at 4,410.13. And then I need to mention the percent, right?
Right. And this is where you pick your adjective. So, strong rally, weak rally, up slightly.
I guess up slightly, 0.28%.
Right.
Because a strong rally would be around 1%, right?
Yeah, 1 or higher, you're going to use much stronger words.
Okay.
0.5, you say respectable or good rally. 1%, that's a strong rally. Up slightly, if you're only up 0.1, 0.2. This is one I'm going to say our well off the day's lows or something are up slightly 0.28%, but a very strong rally off of the day's lows, something like that, right? So here's one where you really got to talk about the lows of the day. Now on Friday, it closed at the lows for the day. You might say that the market was down, whatever percent right at the lows for the day, but you don't have to say that. However, today was an unusual day. You really want to put that into the write-up. Remember, you're trying to make your boss look like a genius. So that's something definitely you wouldn't want her to go and meet with the CEO and not know that, right? So you'd want that to be in the answer so that she looks like she knows what she's talking about. All right, very good, Eric. Everybody got that? Y'all see how that works? All right, someone want to talk about the 10-year?
I can try.
Harder one. All right, go for it.
The 10-year Treasury yield fell 1.2 basis points to close at 1.735% as bonds rose.
And you're right, bonds rose. I like to say bond prices rose. So I'm a little picky on. You're right, and if you said that, that would be correct. I always like to say, am I talking about the yield or am I talking about the price? So as bond prices rose, and is that a big move? So what was the standard deviation we said? 6.5, y'all remember that? So 1.2, what adjective or what adverb we used there, Juan Carlos? Strongly or slightly or some or?
Slightly.
Yeah, that's a pretty weak rally. It looks like it was a pretty strong rally earlier in the day, but that bonds actually sold off. They were still positive for the day, but they sold off in the afternoon, just like the stock market. Well, there's the lows for the day. You can see that, but it was a big rally at the end of the day. So treasuries, and they didn't give us an entire picture on the treasuries. Treasuries were up strongly at one point. probably 4 basis points down and so up in price, but the market treasuries did sell off going into the afternoon and the close. So pretty amazing day. Everybody got that? So anybody want to do crude oil?
I'll try it.
Oh, okay.
All right.
Sorry. Okay. Crude oil was down $1.34 at closing. Excuse me, closing at $83.80 or 1.57%.
All right. All right, so Crystal, very good. So is that a big day or a small day, do you think? We don't have the standard deviation on oil, but 1.57, Crystal, does that sound like a pretty significant day?
I think it is, yes.
Yeah, so down, I might say down significantly. Oil is definitely more volatile than the S&P 500. So 1.6 day may be more like a 2 or 3% day for the S&P. I don't know, I'd have to bring in the dollars. And Crystal's mentioned crude oil is a little strange because you have the Brent and the West Texas. So, you know, if you're interviewing with Valero, you'd want to be real picky. I might on oil, just say oil is down 1.57% and not talk the price just because of that confusion. But if you're going to talk, you know, you'd say, hey, oil is down today. Brent was down $1.34, closing at 83.80. You know, just something like if you're in an interview, you'd want to make a difference between West Texas and Brent. But good, very good. All right, y'all are getting it. You would do the same thing with gold, right? Gold is down $10.30 or down 0.5, or no, I'm sorry, gold was up $10. Yeah, Juan Carlos, I'd have to bring oil prices in, right? You could do that, just bring oil prices in, get the daily change and just see what the standard deviation of the daily change is. Oil, you can probably get back, who knows, probably back into the 20s or 30s pretty easily. So I just don't know. I don't follow oil that closely, so I'm not that much up on oil. All right, anything else look big? Well, NASDAQ was up 0.63%. That's a pretty strong day for tech stocks. And that was all right in the last few minutes. So that's pretty strong. When does gold usually rally? Gold rallies when there's a war about to happen in Ukraine. So that would make some sense, right? You know, you don't normally see gold up when the stock market's up, but gold's really reflecting one thing. There's conflict in Ukraine. And so that's going to stay up. Oil might be reacting to Ukraine as well, right? If there's a war in the Ukraine, what is that going to do to Russian oil and those kind of things? So there's some logical connections you can make to these different things. So when you do the report next Friday on the employment report, you might see oil down a bunch or gold up a bunch, but it may have nothing to do with the jobs report. It might have to do something going on over in Ukraine. But you still want to write about it and give your best explanation and read what other people are saying. All right, any questions on that? Y'all getting more comfortable with this?
I just had a question with the Russell 2000, because like it was like down for most of the day, and then it looked like towards the end of the day it started rallying back up. Like, is there a reason behind that?
Yeah, the Russell are smaller companies. So it's hard to say. You'd have to read something. The Russell has really sold off the last few days as well. I'm a big believer in the Russell 2000. So it's one I hope is up a bunch. Today might have been that it oversold. I don't know what it did on Friday. I'd have to look for that. But it may have really oversold on Friday. It was down quite a bit today, but not as much as the S&P. You know, it's hard to say. With smaller companies, they tend not to be as worried about global events because they tend to be local companies. And so if there's something global going on, sometimes they kind of ignore it while the S&P doesn't. Russell 2000, it definitely has its sector weights that are very different than the S&P. So you'd have to look at that as well. But I haven't seen an article today, but you could probably find one on why the Russell was so strong. But that's a good point, David. That one would probably be one you want to point out because that's a pretty stark difference for the Russell 2000. It is more volatile than the S&P, but not that much more that you would expect it to be up 2.38%. when the S&P is only up 0.28. But good question. Yeah, y'all are, hopefully you're curious about this, right? This is stuff you're actually interested in because you're going to be doing this the next 50 years of your life. So, it's interesting stuff. And you've got the right kind of mentality that I have. It's like, wow, why did that happen? I want to know. You just like, let's stop class right now. We all want to go research that. That's the kind of thing, it's like, oh, good. I picked the right major. If you're sitting there going, wow, who cares about that? That would be good. I'm sorry, go ahead.
Would you be posting this PowerPoints on Blackboard?
I can, but most of this, after this page, it comes right out of the class notes. So the only thing here that's not in the class notes is this right here.
Okay. All right. Thank you.
So, try to write it down as we go or take pictures. The video will be there, Evander. So you can, if you miss something, you can go back and catch that part of the video. If y'all look at my YouTube video, I am putting the index in there. It takes me a little extra time to do that, but I think it helps you so you don't have to, if you're looking for one thing, you can just jump to it.
Yeah, that was helpful when I was watching it.
Yeah, it's there's places where you don't see anything because I only do the screen show, so you just listen to it like a radio show. But that makes it a lot easier because I can't put your faces on YouTube. All right, good. Y'all, this class is very engaged. I like that. Go ahead, Andrea.
So I noticed that when you're like talking about the changes, you don't use the words increased or decreased. Is that like the wrong terminology to use?
You can't say the S&P increased 12 today. That's fine. The 10-year bond yield decreased 1.2 basis points. That's fine. Yeah, decrease, increase is fine. There are words that have meaning beyond just their term, like rally to mean. The word rally to me means something pretty strong. So I wouldn't say Treasury 10-year bond rallied today as yields were down 1.2 basis points because 1.2 is not all that big of a deal. Sell off to me means it was down at least 0.5, if not 1% or more. So you got to be careful how you use it. So Andre, so the word increase or decrease, the question is what adjective you put with that. Increase slightly, increase significantly, increase somewhat. That's probably the hardest part is it, and that's why I'm trying to help you with these standard deviations. When is it a big deal and when is it just a pretty minor day? And that's, those standard deviations I think help a lot. It gives you a good basis for when you should care. All right, good questions. It's a really good engaged class. Hopefully everybody's as engaged as the ones that are asking the questions. All right, so you're ready for exam one. Remember what you're going to do in exam one is we're taking the next, I forget, 20 something pages of the class notes. And exam one has two questions. The first question is essentially for you to take all of those class notes and put them into your words. And you want to do that as we go. All right, you don't want to do it all at the end. If you use too much of my notes and my words, or if you copy another student, you're not going to get any credit. I do check it for repetition. It is an open book question. I used to not do it open book, but when we went to lockdown, I did open book and I thought, wow, the class average is going to be up 10 points. The class average was exactly the same as the previous semester. So it almost doesn't make any difference. But the problem with open book is what? You can copy and paste. If you copy and paste, you will absolutely get a 0. I don't want to read my notes. I already know my notes. I wrote them. So what I'd recommend you do is as we go, read it, think about it, Google a little bit about it, find some things, and then off the top of your head, sit down and type your answer without looking at anything. All right, that way it's in your words and you can make sure you're understanding it and it will go to your long-term memory. All right. All right. So with that said, hopefully you are listening. There's at least 4 students that aren't, and we'll figure that out when we get the exam. All right. So the question is that you might get in an interview. Well, let me tell you the second exam question. So the first exam question is essentially to summarize the class notes. Someone's songs asking about prime versus treasuries. The prime rate is, okay, just real quickly, the prime rate is usually priced off the Federal Reserve, the Fed rate. So the prime rate usually moves in lockstep with the Fed. The Fed is a short-term rate, so the prime rate is highly correlated to short-term rates. Highly correlated to the Fed rate. All right, so there's two questions on the exam. So the first one is you're going to put the class notes and the class instructions into your own words. The second question we'll get into in a few weeks is I'm going to give you a scenario. It's going to start with the words your boss believes, and then you're going to tell me how they should invest that money. You're going to discover that the answer to the second question is nothing more than understanding what you put down for the first question. You don't have to learn anything new. So as we go through the first question, I'm going to be telling you stuff that's going to help you with the second question. You'll see once we get into it, especially when we get into duration, you'll see it'll all come together. But there's two questions on the exam. We're covering both of those questions simultaneously here, right? So the way the question is really set up is you get an interview, and the interviewer said, what if I came to you and told you I just got $500,000? I want you to help me with what to do with that money. What would you tell me? That's what we're going to study here for the next few weeks, all right? I'm giving you a template so you can very intelligently answer that question. So essentially, someone's come to you and said, hey, I want to create an investment portfolio. What do I do? So first, what is an investment portfolio? An investment portfolio is a collection of assets that are held for some future purpose, like retirement. You want to pay for an education, maybe your kid's education, a down payment on the house. You want to leave something to your heirs. All right. I refuse to give investment advice if I don't know what that future purpose is. All right. Every time I go to parties, they introduce me as, this is Ron Sweet. He was head of equities at USA. He's portfolio manager. And then I get the wild questions. I remember one party I went to, and this guy I used to work with at USA introduced me to his wife. Said, hey, Ron was portfolio manager. First words out of her mouth was, should I buy gold? Should you buy gold? For what? You mean for your fillings, for your teeth? What are you talking about? Why are you investing? Why are you buying anything? Are you investing for retirement? Are you buying a house? Do you need to pay for a car down payment tomorrow? Why? Should I buy gold? Well, I'm not going to answer that question. Yeah, buy gold if it makes sense. So yeah, why do you want this portfolio? What are you going to do with this money? A really key concept of this we're going to get into is the word horizon. What is your horizon? If you need the money tomorrow, I'm going to give you a very different answer than if you're 60 years old and this is the money you want to leave to your heirs and you're really healthy. Or you're 22-year-old and you're investing for retirement. If you need the money tomorrow, I'm probably going to tell you just put it all in cash and to be ready for you tomorrow. If you're investing for your heirs in 30, 40, 50 years, I'm going to give you a much more aggressive. I'll probably have you buy some stocks, maybe some gold, maybe some real estate, who knows? But the first thing I need to know is why are you investing? I won't go any further than that. One of the reasons I retired at USA is I moved from the corporate finance area where I managed pension plans and insurance portfolios, endowments, and they made me head of equities to run mutual funds. Well, if I'm running a pension plan, I know what that future purpose is. I got to pay people their pensions. If I'm managing a life insurance company and I'm setting the strategy and policy for there, they've got policies they need to fund. So I had a liability. Then they moved me over to the mutual fund side, and all I had was assets. I didn't have anything I was buying the assets for. And I can't operate in that field. I didn't enjoy it at all. I love having assets and liabilities. To me, that's my forte. That's what I was built to do. I really enjoy that part of it. And that's a tough part of being a portfolio manager where you don't know why people are investing. So you just tell them, hey, this is a growth stock fund. I'm going to buy growth stocks. Hopefully you're buying this for the right reason, but you don't know. But to me, managing a pension plan, managing an endowment, that's a lot of fun because I know why they're investing. I know what their horizon is. I know what their risks are. Are they worried about inflation? Are they worried about interest rates? That helps me know what to buy, right? So that's where I start. So if you get this question in an interview, you say, well, what are you gonna do with that $500,000? You're gonna use it for your retirement? You wanna put it on a down payment on a house? When are you gonna buy the house? You know, before I can help you, I gotta know the purpose for that investing. Now, if they don't wanna answer that, if you don't wanna put them on the spot, you say, you know, I need to know that first, but let's assume you're gonna put it into your retirement plan. Then you can go on to step 2 without them replying, all right? So you can just say, let's just assume this is for retirement. You know, if you want to get a lot of points in an interview and say, you know, you look very, very young, you know, they're 42 years old, say you look like you're about 28, that'll get you some good points in interview, and say, so you've got about 40, 50 years until you retire. So what am I going to do next? All right, so start off with this, what is an investment portfolio? That's what they want you to build. Then you're going to ask 3 questions. We kind of talked about the first question, the why, the what, and the how. All right, we're going to address the why first, which we kind of talked about. The what, we're going to be spending the next 4 weeks on the what, on the asset classes. And then the how, we're going to get into detail after the first exam. We talk about brokers and mutual funds and stocks and bonds and those kind of things. All right, you'll see where we're going in the class. So we're going to start with the why are you investing? Then we'll do what can you invest in? That's where we're going to talk about all the different asset classes. And then the last question is how are you going to do it? And there's a few questions there. All of these are on exam 1. It's just the third question is very high level, and then we get in more detail as we get past the exam. All right. So you see where we're going. You got 3 questions. So on the exam, you start off with defining what is an investment portfolio. And in order to build an investment portfolio, I need to ask 3 questions. All right. You put that into your own words, but that's where we're going. The first question is, why are you investing? What is your primary objective? Why does your portfolio exist? Okay. The purpose is always what I call a liability. What is a liability? A liability is some future cash outflow that you have, right? That's what a liability is. You have to give someone cash in the future. What is retirement? Retirement is you've got to pay your expenses after you no longer have an income. That's a liability. It's a liability to yourself. Health insurance, what is that? So you want to have health insurance after you want to have some money to cover your health care after you retire, whatever Medicare is not going to cover. That's an outflow. That's a liability. Okay. Let's say you're saving for retirement. All right, we cover this much more in detail in my risk management class, but if you're saving for retirement, what are you worried about if you're saving for retirement? Well, there's 3 big things you're worried about: inflation, longevity, and interest rates. Inflation takes off. What's that going to do? It's going to increase your cost of living. You're going to need a bigger portfolio. So inflation is horrible for you if you're retiring. That may mean that lady that asked me, should I have gold in my portfolio? And if I say, well, if you're saving for retirement, yeah, you probably want to have some gold. Why would you want gold in a retirement portfolio? Any guesses on that? What is gold going to do for you?
Doesn't gold back the money we have?
Well, it used to back the money, so but you're on the right spot, right? So if we have inflation and US dollar weakens, I'm sorry, Juan Carlos, go ahead.
I was going to say that, isn't it like a hedge for inflation?
Hedge for inflation, yeah. Yeah, and Krista, you're somewhat alluding to that because inflation is what? The US dollar weakens. It doesn't buy as much. So we used to have, gold used to be tied to the dollar back in the 70s. So now it's not. I'm not an expert in that area, so ask your macroeconomics professors. Yeah, gold does really well anytime there's either an inflation scare or there's some kind of geopolitical risk, like a war or something like that. Gold loves inflation. Gold loves catastrophe. And so, yeah, if you're worried about inflation, gold is not a bad thing to have in your portfolio. So you might put that in that. Longevity. You have a portfolio that's going to provide you income until you turn 92. What if you lived to 97? You're in a lot of trouble. Are there assets that will protect you from living to 97? Absolutely. What does Social Security do? Pays you until when?
till you kick the bucket.
Yeah, until you die, and it gives you inflation. So Social Security covers you for inflation risk and longevity risk. I've got a pension plan at USAA. It covers inflation, covers longevity. There's a product I tried to get patented when I was at USAA, but I couldn't convince the actuaries. But it was a longevity product. It was a product that you'd spend $3,000 today, and if you made it to 95, it would pay you $5 million. If you died before 95, it would pay you nothing. I like that product. I think it's a really great product. I wanted to mix it in with a retirement plan, so the people didn't even notice they were buying that product. It'd be like $10 a month. So they invest $2,000 a month. 10 of it we'd put in this longevity product. The other $1,990 we invest in stocks and bonds. We'd get them to 95 years old. And if they made it to 95, this product would give them $5 million. So then when they ran out of money in their portfolio, they got $5 million. I like that. It's a great product. No one will sell it. I'm hoping one of y'all will start a company and call me up and let me be an advisor to your board, because I think that product would do really well. But anyway, that's a longevity product. There are products out there that pay you until you die. That's something you'd want to have in your portfolio. Interest rates. What do interest rates tell you? Well, interest rates are going to tell you what can you make in the future. If interest rates are 2%, you're not going to make as much of a return as if interest rates are 5%. And so that pension plan is the present value. You know, your pension plan today, the liability today is the present value. Your future pension plan, the lower interest rates are, the bigger that retirement plan is in today's dollars. That's something I had to deal with at USAA. And we actually hedged out the interest rate risk at USAA, and that worked really, really well. But you see, when you ask, why are you investing? It starts giving you ideas about the kind of things you should invest. So you have someone that's retiring, say, hey, why don't we put some of your money into an annuity that would pay you a fixed income for the rest of your life? That way, you don't have to worry about outliving your money. We may not put 100% of your money in there, but we might put 10%, 20%. You know, if your monthly expenses are $1,000, let's get you an annuity, at least gives you $1,000. So you at least have that covered, you know, that kind of thing. So it helps you that you've worried about inflation. Maybe we put some in gold in your portfolio. Maybe we put some treasury tips, inflation protected bonds in your portfolio. Okay, so we're going to talk about that more and more as we get into the what of investing. But you have to ask those questions. So you want to find assets that are going to help mitigate the risk of that liability. You don't want your liability to jump up 50% at the same time your assets are dropping 20%. That'd be terrible, right? That's what I had at USA with the pension plan. The way pension plans invested in 2008, the typical pension plan saw their liabilities shoot up and their assets fall 30%. It was a disaster. We didn't do that at USA. At USA, we actually tripled the surplus of our plan in 2008. I think we're the only plan in the entire United States that did that, because we were hedging that risk. It's a very different way of thinking about how to invest. How do you figure this out? Some firms use risk questionnaires. I hate risk questionnaires. I think they're horrible. I think they lead to really bad behavior. What the risk questionnaire is trying to figure out is the risk profile of their client. So if their client says, hey, I'm really a risky person, I love risk, and you say, you know what, I'm going to put you in a bunch of small company stocks. You love risk, I'm going to put a bunch of your money in the small cap stocks. And someone else says, you know, I hate risk, I don't like risk at all. So, well, I'm going to put you in some real high quality bonds. What's the problem with that? Well, what we know with these risk questionnaires, in a year like 2008, when stocks have sold off 35%, people answer these questionnaires really conservatively. And so what does our industry do? We move them out of stocks into bonds because they answer the question conservatively. What should we have been doing in 2008? We should have been buying stocks cheap, right? But instead, they were scared. They just lost all this money. They answered the question real conservatively. And then you get a year like 1999 when stocks up a bunch, especially tech stocks. How did he answer the questionnaire? Boy, they're aggressive. I love those tech stocks. Yeah, if the market sold off, I'd be buying more tech stocks. Why does the questionnaire say, hey, this person should have a lot in stocks? What should they have been doing in 1999? They should have been coming out of stocks because they're expensive. So in my opinion, this questionnaire is because people answer the questionnaire based on what markets are doing recently, and they tend to answer them really badly. They tend to answer really conservatively when they should be buying stocks, and they tend to answer them very aggressively when they should be selling stocks. I remember in 2000, 2000, a lady at my church came to me and she says, my broker just won't buy these tech stocks. He's such an idiot. What can you tell him? Can you talk to him? And I told her, I wouldn't be buying tech stocks right now. My word, you've seen how overpriced they are. And she looked at me like I was the stupidest person on the planet. Of course, I have a CFA and quite a bit of experience managing, $30-40 billion in assets. She had no background investing, but I was the idiot and she knew what was going on. So I said, okay, fine. But I agree with her broker. You shouldn't be buying tech stocks in 2000. I don't know what she did. But she was an aggressive investor. Why? Because she'd made so much money recently. And that just made her a really aggressive investor. She might have lost 70-80% of her money. I had another person the same year say, my brother and I want to put all of my mom's money into tech stocks. And again, I told him, do you see how expensive tech stocks are right now? That's just ridiculous. And he said, yeah, my brother says every time tech stocks sell off, they always come back. I said, well, there's no rule that says that. There's no law. So how much did tech stocks sell off? They sold off at 80-something%. It took several years for them to come back. His mom was in a nursing home with Alzheimer's. I sure hope they didn't put her entire net worth into tech stocks, but I don't know what they did. I didn't talk to them again. They didn't talk to me again. So I don't like risk questionnaires. However, if you want to do one, the best one out there is, I think Morningstar bought Ibbotson. If you just type Ibbotson, 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 and do Ibbotson risk questionnaire, I think his is probably the best. I really like Dr. Ibbotson. He had a company called Ibbotson and Associates. I got to meet him a couple of times. Really smart guy. He's got some podcasts as well that you can listen to. Really smart guy. I'll tell you one of the stories he told me when we get into duration. I find really, really interesting. But he created this risk questionnaire. He knows what he's talking about. He knows what he's doing. So his risk questionnaire is probably one of the more reliable ones, but it has the exact same problem that people answer it differently based on what markets are doing. If risk questionnaires are really true at capturing people's risk profile, people will give the same answer no matter what markets are doing. And what that means is people don't have a risk profile. What people have is a reaction. People react to what markets are doing. They usually react in the worst possible way. All right. So what I think is most important is the word horizon. Actually, I think that is the single most important thing. What is your horizon? Now, if you take my life insurance class, we write an entire paper on human capital. And what that paper says, it's your horizon and your human capital. What you say there is, how does my human capital is the present value of your future salaries. There they ask the question, how does my human capital correlate with the market? If I'm an appointed judge for life, I have no correlation to the market. I'm going to get a salary no matter what stock markets are doing. I can be real aggressive in the stock market because if the stock market crashes, I still got my job. I'm making a lot of money. If I'm a stockbroker and my job is very sensitive to markets, or if I'm a commissioned sales rep at, say, like a Men's Warehouse or somewhere, where if the stock market sells off, we go into recession, I'm going to be losing a lot of money. I probably don't want to be so aggressive on the stock market side because when my job is tanking, I don't want my portfolio tanking at the same time. So in that class, we talk about human capital and horizon working together to help define your risk profile, or how you're going to invest. But I think horizon is the most important one. If you have 50 years to invest versus if you have 5 years to invest, that's the key. In my life insurance class, we talk about why young people should buy more in stocks versus old people. The normal way you hear that, it's not explained correctly. They use the term time diversification. I assure you, there is no such thing as time diversification. If you hear anyone saying that, a financial planner, you probably need to run for the hills because they don't understand the math. Young people don't buy stocks because they're young and stocks aren't risky over the long term. Stocks are very risky over the long term, even riskier over the longer term. The reason young people buy stocks in their 20s is because most people's human capital is more bond-like than stock-like. Most of you today, if you're in your 20s, your human capital is the present value of future earnings. that future income is going to be pretty stable. It's going to look more like a bond than a stock. And so the argument is your biggest asset right now is your human capital, and your human capital looks more like a bond than a stock. Therefore, you can put a lot more of your money in the stock market because you already have a lot of bond exposure because of your human capital. That's why young people buy stocks. So if you have a young person, you have a lot of human capital, they've got all this future income coming, they're going to be pretty stable. All their needs are going to be taken care of. They're not living off their portfolio. They got an income. They can be very aggressive with their stock portfolio and try to get that higher return. Questions on that?
I just had a question for you.
Okay.
So would also young people say and like invest in more on the stock side as well because they see it on like social media and things like that, the people that are getting rich quick sort of thing?
Yeah, that's why Jeremy Grantham's arguing the stock market is going to drop 50% because he's saying you're starting to see those. You know, I don't know if you do any kind of boy, I can't even think of the word, technical trading. Technical traders, a lot of them that are, you know, watching market prices and 200-day moving averages and those kind of things. A big part of that trade is the retail investor. The retail investor tends to be pretty predictable. They're the ones buying stocks, borrowing money to buy stocks at the top, and they're the ones selling off at the bottom. And so that's why we look at odd lots and those kind of things. And so the retail investor gives us a pretty good signal that the market's at its top because they haven't been in the market for a while, and suddenly they're not only jumping in, but they're borrowing money to jump in. They're doing really stupid stuff. And you notice it because they're doing odd lot trades. They're not $1 million investors. At the bottom of the market, you notice the retail investors getting out and the big institutional investors are getting in. And so, yeah, that's another reason young people invest, but that's not the reason they should invest. You know, I personally think 20-year-olds should go 100% in stocks and not even look back. If you go online and look at it, they'll tell young people put 90% in stocks and 10% in bonds. I don't like that idea. I think that's pretty crazy. The reason is that 10% in bonds, you're not going to even notice it. I've never heard I didn't hear anyone in 2008 that had 90% stocks, 10% in bond goes, boy, I'm so glad I put 10% in bonds. I only lost 32% instead of 35%. I didn't hear anybody say that in 2008. But if they had been 100% stocks, they would have been back and have a whole lot more money today than if they'd been 90-10. So to me, that 10% in bonds is just not doing anything for you. So I think young people, if I were a young investor, you can read my blog. I have a blog on what I would do if I was a young person. It's a pretty radical blog. It's not my recommendation, but it's what I would do if I were your age. But I'd be 100% stocks, and I'd probably take 10 to 20% of it for some crazy bets. Maybe I find a company that's developing new batteries or EVs, or maybe I got a firm like DoorDash or Uber that's going to be doing the home delivery kind of thing. I just listened to a podcast last week about microbes and what microbes are going to do to health going forward. It was a really grotesque podcast to listen to, but boy, they're talking about radically changing the world. I might put some of my money in those type of businesses that may not even have revenue yet, but boy, they may change the world. I might put, I might say, I'm going to take 10% of my portfolio. I'm going to find 10 companies. I'm going to put 1% in those 10 companies. I'm never going to rebalance. None of them may go insolvent, but one of them might be the next Microsoft, and I'll be up 80 million%. That's the kind of way I might invest if I were your age. And if the stock market falls 10, 20%, what do you care? You're just buying stocks cheaper, right? You're not going to even notice it. But that's not the same thing I would say to your grandparents, right? If I told your grandparents that, they'd probably be pretty upset for me to tell them that. So that horizon, I think, is really, really, really key. All right, so we got a technical trade out there. So yeah, Douglas, join the investment society and teach a technical trading class. Our technical trader teacher from last semester graduated, so we don't have that anymore. All right. So I believe if you don't have a liability and you don't know what the person is investing for, I don't think you can go further. You got to stop there.
Sorry, I have a question. So Horizon, does it has like another meaning on a financial term or investment term, like other than emergence or something like that?
Well, horizon just means how many years before you're going to start drawing money out of the portfolio. So my definition of horizon, what's the first day you're actually going to take money out of the portfolio to pay for whatever that liability is? So if it's someone retiring at 65 and they're 25 today, then horizon's 40 years.
Oh,
I
okay.
retired at 46, but I'm not drawing on my portfolio, but I retired at 46. I may never draw on my portfolio. I've got so many income sources, but so, I might have a portfolio that really is for my heirs, but I don't have any heirs. So it may be for my charities. So my charities are kind of hoping I drop dead. But yeah, I'm kind of just, I got to ask that horizon. So maybe the horizon is my charities. I might say, I can be pretty aggressive. It's for my charities. They may not want me to be so aggressive, but, I might live another 20, 30, 40 years. Who knows? So you have, horizon can be very different for very different people. Any other questions on the why? Let's get started on the what. The what is going to be in the next 4 weeks, so we're going to spend a lot of time on the what. The what is, what do you invest in? It's those asset classes. So what we're going to be doing the next several weeks is going through the asset classes in detail. Something I think is extremely powerful. I'm going to be giving you some, mnemonics or acronyms. You may have heard some of them. Have any of y'all heard DC cuts I yet? When Carlos is around the investment society or not? So DC cuts I caught a former student that took the class 5 years earlier. And I said, what do you remember from the class? DC cuts I. Duration, convexity, credit, US versus non-US, taxes, structure, style. Structure, inflation. DC cuts I. So he remembered that 5 years later, and he could still talk through them. When we get to the stock side, we're going to talk about BUCS, BUCS, beta, US, non-US, capitalization, structure, style. So I'm giving you some ways to keep it in your permanent memory, and you're going to see this is really where finance is on the investment side, understanding these different asset classes. You're not going to just stick your customer all in the S&P 500, although there are people that do that. Do you want to buy stocks outside the US? Do you want to buy high yield bonds? Do you want to buy short-term bonds or long-term bonds? Do you want to buy mortgage-backed securities? Do you want to buy European stocks? Do you want to buy stocks in South Africa? Do you want to buy Bitcoin? I'm not covering Bitcoin because it's not my thing, but do you want to buy gold? We will talk about gold. Do you want to buy cattle? Do you want to buy corn futures? Whatever, so these are the asset classes we're going to talk about. Now, what is an asset class? So we could get really, really, really picky and say every single asset is an asset class. So Apple stock is an asset class. Gold is an asset class. A bond loaning money to IBM, that's an asset class. Well, that's getting a little bit rough, right? That's tens of thousands of thousands. Every commercial real estate property is an asset class. That's a little too detailed. I could say there's just two asset classes: equities and bonds. Equities, that's stocks, real estate, commodities. And bonds is anytime you loan someone money. So we just have two asset classes. Well, that seems a little too summarized. So how do we decide? Do we have two asset classes, or do we have 80,000 asset classes, or do we have 10? Do we have 50? And William Sharpe, you've heard of William Sharpe, haven't you? The father of modern finance. Does that sound familiar? Nobel Prize winner. You've heard of the Sharpe ratio, haven't you? You've heard of capital asset pricing model. So William Sharpe, he wrote a paper that I read, and boy, I one thing I did at USA that I encourage you to do, maybe a little dangerous, it's probably dangerous when I did it, but I'd read an article and get so excited about it, I implemented it immediately. And that's what I did with this article. I read it and I started doing it immediately. But it's an article William Sharpe wrote where he was asking the question, how many asset classes should you have and what are they? He came up with 13. I'll show you his next class. I'll show you his 13. He came up with 13. I'm pretty sure he would not have the same 13 today that he had back then. He came up with 13. Why 13 and not 32? Why 13 and not 4? And he used this term that I'd never heard before, but my English teacher says, oh yeah, that's a common term. So hopefully you've heard this term. But parsimonious, does that sound familiar? Use it in a sentence this week and see if your friends understand what you're saying. So your friends invite you out for a steak dinner and you say, hey, I'm being parsimonious right now. Just see what they say. Or let's say, hey, yeah, steak dinner. Hey, forget parsimonious. I'm ready. Let's go. You know, see if you can use it and see what they say. So what does parsimonious means? You want to be stingy. I think a better way is you want to be extremely efficient. You want to have enough asset classes and no more. All right. So what does enough mean? The key for enough is you want to be able to explain as much risk around the world as you can. You want to have enough asset classes so you can really explain risk really, really well. What do we mean by explain risk? Hopefully you remember from your statistics class, the R squared. R squared gives you that explanatory power. How much of the volatility of A can be explained by the volatility of B. We want to have enough asset classes so if someone brings a portfolio to us, we run that portfolio against our asset classes, we can explain the overwhelming majority of the risk that portfolio is taking. So if we get an R squared of 20%, because you're only using 3 asset classes, we have to say, hey, you know what? We can explain 20% of the risk you're taking. There's 80% we don't know what it is. We only have 3 asset classes. And then then we go to 200 asset classes. And we explain 99.999% of the risk. Well, what's wrong with that? Why don't you do 200? Well, anytime you have a new asset class, you now have to go out and do a manager search for that asset class. At UTSA, we interview between 400 and 600 investment managers every year. We had to have at least 5 to 10 that we interviewed for every asset class. And so if we added a new asset class, we had to now go out and interview 5, 10 companies to see who we're going to put in that asset class. It's a lot of work. So we're going to talk about real estate investment trusts. Is real estate investment trust a separate asset class, or is that just another small company stock? The question is, does it help us explain risk better? If it doesn't, we don't need it. Now, if you take my risk management class, they actually do this analysis. If you're not taking my class and you're not planning to take it, but you want to do this analysis, email me. I'll send you the class videos and you can do it yourself. Everything you need to do what William Sharp's talking about here, you can do yourself. It's actually quite easy to do. It's called a style analysis. And so next class, I want to get into what is a style analysis? What does it mean? All right. You don't need to read William Sharp's article between now and next class, but it wouldn't be bad. It wouldn't be bad for your career to do it. He uses quadratic formulas to do it. I don't have his math chops to do that. It's been a while since I've set that up. I'm real lazy. I use Excel Solver to do it. Excel Solver works just as well, and it only takes 1 click. But you can use quadratic formulas. I'm a little tough with quadratic formulas when you have 13 inputs like that. So it's to me a little tough. So when you read his article, he's using quadratic formula. But other than that, the article is very readable. So you just substitute Solver in Excel for a quadratic formula, and you can do everything in that article. So we'll start there next class and get into this. Any questions? I'll stay around if y'all have questions. Pretty interesting market again today. Saw the opposite today that we saw Monday, all right? Today it rallied and then it sold off after the Fed meeting. Monday it sold off and then rallied at the end of the day. So it's been pretty interesting. I'm hoping it stays like this so you have something interesting to write about next Friday. You saw gold sell off a lot today. It's always good to try to come up with stories for why. You know, gold loves a weak dollar, loves inflation. If the Fed raises rates, that usually means the dollar will strengthen. I didn't look at the dollar today. Let's see, what did the dollar do today? You would think it would have strengthened. Yeah, it's hard to, boy. Kind of interesting. Yeah, that doesn't look like it, but I don't have a good dollar index on my machine. But anyway, gold selling off. You would think gold selling off because the increasing rates, which means a stronger dollar, then gold prefers weaker dollars. So, you know, you look at these big sell-offs. What is not authorized to talk? Sorry, I don't. Let me go back. I'm pushing buttons because I'm trying to undo the waiting room thing and it won't let me. Yeah, I don't know how to undo that. So okay, maybe that's, I'll say, I don't know if that fixed it or not, but
It fixed it.
that work? All right, boy,
Yes, it did.
why Zoom? And I got to hit the mid all over again. Frustrating. All right, I thought I set it up well, but boy. All right, so gold was down almost 2% today. S&P was flat, but it was up. Well, I don't know how much it was up today at its peak, up quite a bit today. NASDAQ was flat today. Really, the S&P was flat today. What did the 10-year Treasury do today? Up 6.5 basis points. That's a pretty interesting number, isn't it? What do we say about 6.5 basis points? That's a 1 standard deviation. So Treasuries sold off pretty strongly today. I somewhat noticed it because I've got a short Treasury fund that I'm investing in, and it's up 1% today. So it actually benefits when rates rise. So Treasuries are down. My little fund was up today. Yeah, it does look like the dollar strengthened, but boy, I hate currencies and I always get confused. I need my little currency index off of Bloomberg. All right, so interesting day. So you'll see next Friday when you write about the report. Hopefully we get a big day next Friday. This should be a very interesting employment report. Have y'all ever heard of a economic report where they say good news is bad news or bad news is good news? Has that you ever heard that before? And that's usually during a Fed cycle. So why would bad news be good news? Well, if we get a bad employment report next week, normally stocks would rally. But if you get a bad employment report next week, maybe that means the Fed can't raise rates. So maybe the stock market actually rallies because they think that's going to keep the Fed from raising rates in March. That would be a bad news is good news kind of scenario. A good news is bad news is we get a really strong report next week with inflation numbers. And the stock market sees that as, boy, that gives the Fed no choice but to raise rates. So then you get a good report and the market actually sells off. So we'll see. It's going to be, I'm hoping it's a big report. I'm hoping it's not a boring one where numbers came in as expected and there's not much of a move. I'm hoping it's a crazy report. I have no control over that because we got to pick what a report comes in at the beginning of the semester. So we'll see. Some of you are a little worried about the paper one, but trust me, next Thursday we will spend quite a bit of time. I'll give you the links you need to be looking at. One thing I will say is from now for the rest of your life, the first Friday of every month, you'll be eagerly awaiting the employment report. This will be your life story for the next 50 years. I missed a couple of them now, but I'm retired, so I can. But I can assure you on the job, the employment report day, everybody's looking for that report. It's just so critically important. All right, sorry, I got to keep admitting all here. All right.
And it's on Friday after closing, after the market closes?
No, I mean, it's going to come out before market opens.
Oh, okay.
So usually that first Friday you're at work and I always get confused because of the time change. I can never remember if it's 7:30 New York time and 8:30 San Antonio time or 9:30 San Antonio time, 8:30 New York. I always get, or 9:30 New York, 8:30 San Antonio. I think it's 9:30 New York, 8:30 San Antonio, but it might be 8:30 New York and 7:30. You think I would know that by now, but I've been retired for a long time. So, all right. Hopefully it's a really good report. We'll see. It is the most important economic number that comes out. That doesn't mean the markets always react strongly to it, because if it comes out as expected, then everybody's like, ho hum, that's what we thought. Right now, though, we're getting a lot of surprises because of Omicron and things going on around the economy, and so it's interesting. It should be an interesting report. All right, it's our third day. Today we'll finish up the 3 questions, get into the major asset classes, and see if we can make a little bit of substance there. Real quickly on some groups, the investment society's first meeting, they've actually going to do them on Wednesday. So it'd be Wednesday, February 2nd, is our first meeting at 7:45. It will be by Zoom next week, and then hopefully live in person. But hopefully we'll do what we did last year, where once we come back on campus, we'll be both on campus and live, so you can do both. So that Zoom hopefully will work every week. We'll see. Hopefully they've had some confusion. One thing I'm trying to get them to do is have one place everybody can go to find that stuff. And they've had some debate on what that's going to be. And I told them, you have some place everybody can go and find it. Here's the Professional Businesswomen Society. They have a meeting during our class, starts at 5 o'clock, but you could probably jump on and join their meeting at 5:15 after our class. I could not find the link to their Zoom, so I'm not sure exactly what that is, but you could probably find them on Facebook. I mean, they are on Facebook. Find them or look for a website or something where they give you that detail. So that's a really good organization. I know the lady that started that is still very involved in UTSA. She comes back as an alum. And then Crystal, I don't know if you're on, if you want to talk about your organization. Is Crystal out there? I don't see her. Right. Well, she comes in later, but she had a fraternity she wanted to talk about. So if any of y'all, anybody else has groups or organizations you want to highlight, let me know. I do encourage you to get involved in at least something. The investment society is a really, really good one. Get involved in something, build your network, put it on your resume. It's really, really important. Okay, so last class, we were doing the what question, and we were talking about this William Sharp article. So let's actually look at the article. Written back in 1992. Sorry, it's really small print, so just get really close to your computer. 1992, and William Sharp, father of modern finance, Nobel Prize winner, very famous person. He's the inventor of the capital asset pricing model. And he called it asset allocation, management style, and performance measurement. That word style is the key here. This is what we call style analysis. And I started doing it at UTSA the second I read this article. I really got into it. So what he's talking about is factor models. And what you're trying to do is figure out what factors influence are impacting your portfolios. So you have weights for each factor, and then you have an error term at the end. And what you're trying to do is figure out how much of what you're looking at you can explain by these factors. And what he says is the key there is the R squared. The R squared is the percentage of the volatility of A that can be explained by the volatility of B. Essentially, what he's trying to do, and this is real important stuff in investing, is he's got this portfolio manager who has historical returns, and William Sharp wants to say, well, if I would take that portfolio's returns and correlate them against indices for several markets, how many markets we have, that's what he's going to ask. How much of the volatility of that fund could I explain with these different asset classes? I think I told you he had 13. He actually has 12. And he said, based on his model, and you see the word, the R squared's in there, parsimonious is in there. I forget the first time he used that word. Parsimony. The efficiency, the stinginess. You don't want more asset classes than you need. So if you get a good R-squared value, the fewer asset classes, the more likely the models represent fundamental relations. If he says if you get too fancy, get too many asset classes, you're really not going to be able to do something that is predictive and stable and reliable. So you can't say every single security and asset in the world is an asset class. It's too much, it's too noisy. He doesn't mention what I talk about, which is more asset classes means a lot more work. So if it's not adding value to your analysis and your understanding, adding another asset class is really not a good thing. It's a waste of time. So here's his asset classes. We are going to use some of these, but not all of them. He says bills. He's not talking about Buffalo bills or something like that. He's talking about treasury bills. We're not going to call it bills. We're going to call it cash. What he calls bills, we'll call cash. We'll talk about cash here in a little bit. Then on his bonds, he has government bonds, and he breaks up between intermediate and long-term. Why doesn't he have short-term? Because that's what the bills are. The bills are short-term treasuries. We're definitely going to use the terms intermediate, long-term. He has corporate bonds. Why doesn't he break corporate bonds up between intermediate and long-term? He could have done that. Probably the reason he didn't is that data was really hard to get back in 1992. We're definitely going to have mortgage-backed securities in our analysis. So he has that there. We'll talk about this term convexity. Hopefully you've heard convexity before, but if not, I'm going to assume you've never heard of it before. He has large cap. Well, we're definitely going to have large cap value, large cap growth. That will be a big part of our analysis. Large capitalization means they're really big companies out there. He has medium cap and small cap. We're going to talk about those as well. Notice he doesn't break medium cap and small cap up between value and growth. We'll talk about that. Why didn't he break that up? Then he has non-US bonds. We're going to talk about that one and talk about why we might not have that in our list. Then real strangely, he has European stocks and Japanese stocks. We're definitely not going to do that. And I doubt he would do that today. Why does he break Japan out as its own thing? Well, back in 1992, Japan was over, well, maybe not 92, but in 89, Japan was over 50% of the world stock market, excluding the US. That's not true today because Japanese stocks have sold off dramatically. But back when he was doing his analysis, Japan's stock market was a major stock market. We're going to talk about, for our purposes, we're going to talk about developed markets, emerging markets, and frontier markets. So he's very similar to what we're going to use in our class, but there will be some differences there. So he's saying these 12 are the ones you need to be able to explain the risk most portfolio managers are taking. Are those the best 12 today? I wish he would update this article and show us what he thinks the answer is today. He hasn't done that, but I doubt it would be the same list here. I think he would actually look closer to what we're going to talk about in our class, especially having emerging markets as a separate one. So what is he trying to do? So let's look at this here, see if I can blow this up a little bit. So just as an example, he went out and found a portfolio manager. The portfolio manager he found is a company, a fund called Trustees Commingled Fund. Anytime you see the word commingled, that usually means they have both stocks and bonds in the same fund. And he's going to use regression against his 12 asset classes. So he's taking the returns of these 12 asset classes. He's taking returns of the trustee fund, probably on a monthly basis. He's going back 5 years. And over a 5-year period, he's trying to ask how much of the volatility of this fund, the Trustees Commingled Fund, can I explain with these 12 asset classes? The first time he ran it completely unconstrained. And unconstrained in 2 ways. First of all, when you add up the allocation, it doesn't add up to 100%. Secondly, he's allowing negative allocation, what we call shorting. When he did that, he could explain 95% of the volatility of trustees. He then started constraining it And the first time he constrained it, he made sure allocation adds up to 100%, but he still allowed the negatives. The last time he ran it, which is the way I do it in my risk management class, is he forced it to add up to 100%, and he got rid of negative numbers. And there his R squared fell down to 92, but 92 is still pretty strong. He can explain most of the volatility of this fund. And what did he discover? This is a fund that's about 70% value stocks and about 30% small stocks. So it doesn't have stocks and bonds in it. So the word commingled, well, I'm probably misusing the word commingled in this context. So essentially, this is a stock fund. It has large company stocks in it, has small company stocks in it. Remember, I said he didn't break small stocks between growth and value like he did large company stocks. But my guess is if he had broken small company stocks between value and growth, this thing probably would have been 30% small cap value stocks. This is probably a value portfolio. So we're going to talk later in class, what do we mean by a value portfolio? What's a value stock? What's a growth stock? Why are growth stocks selling off the last few weeks? So we'll get into that more as we get into the asset classes. All right. So I just want to show you this article. Any questions on that? I do encourage you, in your own time, you could certainly read through that.
What does it mean by unconstrained and constrained?
Well, there's several ways you can constrain it. He only has two constraints. So the unconstrained is he didn't put any constraints on the model. So if you ran this in Excel or someplace, he would just say, run it, give me the best answer. But when he did it the first time, it only added up to like 70-something%. Well, if you have a portfolio and you have all your asset classes, you should have to 100%, right? So the first time he ran it, he only allocated 75%. Where's the other 25%? Doesn't make any sense. The second constraint he put on, he says, do not allow any negative values. Don't allow like a negative 68% allocation to bonds. The third time he ran it, he put two constraints. It must add up to 100% and no negative numbers. And that in my risk management class, that's what we do. Add up to 100%, no negative numbers. And when he did that, his R squared dropped. Your R squared is always going to drop when you put a constraint on. There's no way to get around that. But his R squared didn't drop that much. It dropped from 95% to 92. So he's still explaining a lot. And when he did that, he essentially showed this is a company that's buying large and small company stocks, and it has a very strong value bent. And we'll talk about value. All right.
So when he did all those analysis with three iteration, I guess you end up with value and you end up with small stocks with the high mark. What's the conclusion? Maybe I'm jumping ahead of you.
Well, let's say you had hired that trustee fund and they told you they were a large cap growth manager. And then you run this style analysis and you go back and say, you're not a growth manager, you're a value manager, and you buy small cap. And in fact, there's been some analysis on this. If you look at large cap managers, there's been an analysis that actually shows the majority of the outperformance of large cap managers isn't that they're good stock pickers, is that they put 20-30% of their portfolio in small cap stocks. So it's not that they're good managers, they're just taking risks they didn't tell their customers. They told their customers, hey, we're a large cap manager, but they went out and put 30% of their portfolio in small cap. When you run this style analysis, you now got them. And say, you're not, you had a higher return to the market, but you also took more risk. You bought small company stocks. So I'm not going to reward you for beating the market because you bought small company stocks. I've got a small company stock portfolio over here. You kind of doubled me up on that. You bought more small cap. I wanted you to buy large cap. You bought some small cap. I wanted you to be value. I wanted you to be growth, and you're actually value. So it gives you a way to test to see if the manager's actually doing what they said they were doing. It's pretty powerful. It's pretty common. You'll notice it. I don't know if y'all follow Morningstar, but if you put a mutual fund on Yahoo Finance, a Morningstar box will come up, the style box, and they'll tell you how that manager. We'll look at that a little later as we get into some specific companies. But Morningstar will tell you, is this a large cap manager? Is it more value? Is it more growth? Is it small cap? Are they doing international stocks? And so they'll actually do the style analysis, exactly what we just did here, do the style analysis to tell you what this manager is really doing. All right, so let me get back to the PowerPoint here. Sorry. All right, so style analysis is you're figuring out really how many asset classes you need to have. So if you're looking at all your portfolios and you're running the style analysis and you get R squareds of 40%, 50%, you don't have enough asset classes. You need to add more. If you get 98%, 99%, maybe you have too many, maybe you can pull back. So let me give you an example here so we can actually look at it. Let's say your boss says, okay, we have 5 asset classes that we use and follow. Look at our portfolios and see how much our historical volatility you can explain. So you run the analysis and you say, I can explain 70%. So your boss says, wow, there's 30% risk we're taking that we're not explaining. Let's add some more asset classes. So maybe you break small cap between growth and value. Maybe you add some international emerging market stocks or something. So you get up to 10 asset classes, and now your R squared is 98%. And your boss says, wow, that's really, really good. But maybe why don't we break it out a little bit more? Maybe we break international stocks between growth and value. Maybe we break bonds between corporate bonds and treasury bonds. So you come up with 15 asset classes, you run your model again, and now you're explaining 98.1%. Well, the best answer, the best way to go is 10 asset classes. There's no reason to add those other 5 asset classes just to get 0.1% better explanatory power, because those 5 asset classes are going to be a tremendous amount of work. You're going to have to go interview them all. You're going to have to track their performance, all those kind of things. So 10 would be the ideal answer. Maybe 9 is the right answer. Maybe 8's the right answer. You know, we don't know what those other places are. At USA, we came up with 13, which I thought was the same as Sharp, but Sharp had 12. We came up with 13. We had some asset classes he didn't have. One of the biggest ones at USA was real estate, because obviously USA has a really large real estate subsidiary. And so we had real estate as a separate one. We had emerging markets, which he didn't have. So, you know, not everybody agrees what the right asset classes are, but they're all doing very similar type of analysis. They're looking at all the portfolios they're interested in and asking, how many asset classes do I need so I can explain the risk we're taking? We want to know where our exposures are. Are we exposed to large cap, small cap, value, growth, all the way throughout? And the key to this are these 3 inputs: return, volatility, and correlation. That's the real key. If an asset brings some type of unique return or some type of unique volatility or some type of unique correlation, then it probably should be added into your analysis, because it's going to help you explain risk. One thing I do in my risk management class is I added gold to the analysis because of the inflationary period. Well, what does gold bring? Gold has a horrible return, expected return, has really high volatility. It looks like an awful asset class, but what does it really bring in? It brings in low or negative correlation. It's a good diversifier, especially in a crisis. And so I brought gold into that class so that they could experiment a little bit with gold. All right. We'll get back into that. The what, we're going to be spending a lot of time on the what.
Can I say that is the purpose of having that style analysis is to match your asset allocation to the expertise of your staff?
I haven't heard it said like that. Usually the style analysis, first you're asking, everybody wants to know what risks they're taking. So you want to know where your exposures are. So if you run the risk analysis, the style analysis, you've got a 10% exposure to gold, you might say, wow, that's really, really high. We may need to pull back on that. If you have a high exposure to long-term bonds and you're worried about interest rates rising, you might say, wow, we need to pull back on that. It's really asking where's our exposure? What risk are we taking? And that's the normal way that it's done. But it's also a way to test to see if your portfolio managers are doing what they said they're doing. So those are probably the two best. I encourage you, find a good mutual fund out there. Like maybe I could even show you one. I'd have to get into Yahoo Finance. Let me find one and then I'll share the screen here. We're going to do this a little bit later, so I don't want to do too much here. But okay, so let me share this with you. So this is the Fidelity Contra Fund, pretty famous fund historically, and it's down almost 2% today. Or yeah, today. So if you click on the profile, you'll see this. Y'all see that Morningstar box? So the question is the Fidelity bond stock fund? It's a stock fund. It's the Fidelity Contra Fund. Is it large companies? Is it medium companies? Is it small companies? Is it a value fund? Is it a core fund, which means blended between value and growth? Or is it a growth fund? I see Fidelity Contra Fund. It says contra, that means kind of contrarian. I might think, wow, that sounds like a value fund to me, but what does Morningstar tell you? How would you describe the Fidelity Contra Fund based on Morningstar? Takers?
Large cap growth.
Large cap growth. So if I thought Contra Fund was a large cap value, I would run this analysis. So Morningstar has done exactly what William Sharp did. They ran the Contra Fund against a bunch of indices, and their models show that it was predominantly large cap growth. That's what they do, which is probably why they're down so much. So yeah, it's a good analysis. It does help you understand what you're hiring, what you're getting. Okay. All right, let's get back to the PowerPoint. We're going to come back to the what question. So before we do that, I want to do the third question real quickly. So remember, the first question is, why are you investing? The second question is, in what are you investing? Those are the asset classes that are in your list, your universe. The third question is, once you decide why you're investing and what you're going to invest in, the next question is, how are you going to execute this? How are you going to do this? And there's a few questions you need to ask here. First, what is your strategic allocation? Strategic allocation, that's the allocation you would have if, let's say, you're going to go with Bezos or you know, it's one of these high flyers. They're going to fly to Mars and stay there for 40 years and come back. Maybe you can do trips. You're not going to be able to do any trading for the next 40 years. Your strategic allocation, that's the long-term allocation you do. Just do it. If you had to set it and let it ride, that would be your strategic allocation. That might be 40% large cap value, 40% large cap growth, and 20% small cap, or whatever you're doing. That's your strategic allocation. The next question you got to ask is, okay, I know where I'm normally going to invest. Now I got to ask the question, am I going to do this myself, or am I going to hire someone else to do this for me? And that can be a mixed answer. You can say, I'm going to do the large cap through an external manager, but I'll do the small cap myself. I'm really good with small caps. So I'm going to buy my own small cap stocks, but with large cap, I can't really beat the market there. I'll just hire a Fidelity Contra Fund or something like that. So decide if you're going to do it yourself or hire a manager. And your last question is, okay, I got this strategic allocation. I know whom I'm going to hire, either it's myself or somebody else. Then the question is, how tactical am I going to be? I know normally I have 40% large cap value, but maybe I think that asset class is going to do really well. Maybe instead of 40%, maybe I'll go 50%. That would be a tactical bet. With the word bet, it's a pretty common term. It sounds bad, but we use it a lot in finance. What bets are you taking? What tactical bets are you taking? So if you think tech stocks are gonna keep selling off, then maybe you would under allocate to tech stocks and overweight to value stocks. So part of that question are you going to be active or passive? We'll get into this a little later in class, but passive means you just buy the market. You go out and you find a S&P 500 index fund, which we'll talk a little bit later. If the S&P 500 is up 5%, you're going to be up 5%. If it's down 10%, you're going to be down 10%. But you could be active, like that Fidelity Contra Fund. The Fidelity Contra Fund is trying to beat the market. It's not buying exactly what's in the market. It's overweighting some things, underweighting certain things. It's being active. You're going to have to pay for that. It's more expensive, but you're hoping they have some skill and that they can help you beat the markets. So those are the type of things you need to ask when it comes to the how question. So execution is what you actually buy, those actual vehicles. We're going to get into those: mutual funds, ETFs, commingled funds, separate accounts, those kind of things. So you might hear the term alpha risk. Alpha risk is that's the risk you're taking trying to beat the market. So if you hired a Fidelity fund and their large cap growth and a large cap growth index is up 8%, but Fidelity Contra is only up 3%, then you took risk. You could have just bought the market and made 8%. Instead, you hired Fidelity and you only got 3%. So you missed out on 5% you could have had if you hadn't hired this manager. So you can be tactical on within an asset class. You can hire Fidelity and try to beat large cap growth, or you can be active on the asset class itself. So you think, we normally have 40% large cap growth, but I think they're overvalued or are going to sell off. So I'm going to underweight large cap growth. That's essentially what you're going to do in the second question on exam 1. So we'll be getting into that a little bit more. So we'll definitely be talking the how question in more detail as we go. Well, here's the strategic versus tactical. You can read those in the class notes. There's a Brinson study that is maybe the most misquoted study in the history of finance. They said well over 90% of the risk a portfolio has is in that strategic allocation. Financial planners quote the study and they say over 90% of your return comes from the strategic allocation. That's not what the Brinson study said. The Brinson study said over 90% of your risk can be explained by your strategic allocation, that normal allocation. It didn't say anything about return. So if you ever hear the Brinson study come up, you'll probably hear it misquoted quite horribly. They'll talk about it in terms of return, where Brinson was only talking about in terms of risk. Just what we just did, that R squared. How much of the risk can you explain? That's what Brinson's study was looking at. You can look it up and read the study. It's a very old study, but it's quoted quite a bit. It's terribly misquoted quite a bit. In the tactical, we're going to get into that. What do you overweight? What do you underweight? All right, let's get into the 4 major asset classes. All right. So cash and cash equivalents, bonds, stocks, also called equities. I don't like the term equities, even though I was vice president of equities at UTSA. The word equities means something different than stocks. So I don't like that term, but stocks are equities. And then alternatives. Those are our 4 asset classes. Now remember at UTSA, we broke it up a little bit more. We had cash, bonds, stocks, real estate, and alternatives. So we broke real estate out. Real estate's usually part of alternatives, but at UTSA, we broke real estate out as its own asset class. So these are the 4 we're going to use in this class, and these are the most common ones, but there are other ways of breaking it up. Depends. If you don't have access to real estate, if you only have $100 million or so and you really can't buy investment real estate, then you wouldn't have real estate even under your alternatives, all right? So the key on the exam when you get to these is on cash and bonds is how do you distinguish between cash and bonds, cash and cash equivalents? So the key here is they're both loaning money. All right. I've got to somehow figure out how to get y'all's videos, your faces back up. I can't see y'all. I don't know why I can't see y'all anymore.
I'm seeing you.
Yeah, I clicked the wrong button and I accidentally lost all your faces. So anyway, all right. So how do you tell between cash and fixed income? Now, fixed income and bonds, we use that interchangeably. Fixed income, bonds, we use it's the same term. So, but they're all loaning money. So a T-bill we classify as cash. A T-bond, a treasury bond, we classify as a bond. Why is a T-bill cash? And why is a T-bond a bond? Both of them are loaning money to the US government. Well, the key are these two risks. You distinguish between cash and fixed income, looking at reinvestment risk and price risk. All right, what is reinvestment risk? Reinvestment risk is when you have a bond mature, and when it matures, interest rates are really, really low. I had a friend of mine who he was gloating in 2008 because his entire portfolio was in CDs, certificates of deposit. He talked about how stupid we all were, and he had everything in CDs. Well, that's great. CDs, his CDs were making 4 or 5%. He thought, wow, I made 4 or 5% when the stock market was down 35. I was really smart. But then those CDs matured. And what was he getting when they matured? He was lucky to get 1%. So he saw his retirement income drop 80% very quickly. That's reinvestment risk. He has a 5% CD, matures. Now he wants to reinvest, and CD rates are no longer 5%, they're now 1%. That's reinvestment risk. Price risk is the risk, it's also known as interest rate risk. It's the risk you're exposed to because interest rates are changing. So price risk, we know bonds fall in price when interest rates rise, but it depends on the duration. We're going to talk a lot about duration here pretty soon. Depends on the duration. Longer duration, longer maturity bonds have more price risk. What that means is a long-term treasury bond has much more price risk than a T-bill, a 3-month T-bill. Because if interest rates rise, the T-bill's price will hardly move at all. But the long-term treasury price might fall 10, 15%. So cash, so make sure you're having this in your notes, very, very important. Cash has very, very high reinvestment risk and very, very low price risk. Why does cash have high reinvestment risk? Because it's cash. It's constantly maturing. If you have a savings account, you're getting whatever the current rate is on a daily basis. The bank's just going to change their rates whenever interest rates change. So your income's going to jump up and down all over the place. You're very exposed. So if you're worried about rates falling and you have everything in cash and rates fall, you're going to see your income drop quite dramatically. But if rates rise, T-bills and other cash-like instruments, their prices will hardly budge at all. They'll probably stay right at the same price they were at. They have very little price risk. Bonds and fixed income have, I'm sorry, go ahead.
Oh, sorry, teacher, can you go over reinvestment risk again, please?
Yeah, reinvestment risk is you get cash out of your portfolio, it matures. Something matures, like a CD matures or a bond matures, and it matures when interest rates are really, really low, and you need to reinvest the money. So let's say you bought a $100,000 CD 10 years ago or 5 years ago, and it was paying 5%. You're really happy. You got 5% for 5 years, and now it matures, and you get your $100,000 back, and you say, well, I want to roll it over into a new CD. So you go to your bank and say, well, let's roll it over. And they say, okay, our current rates are 1%. You were making 5%. Now you're making 1%. You're pretty upset. That's reinvestment risk. Now, it could help you, right? You could have that bond mature at 100,000 and it was paying 5%, and now current rates are 8%. So you could actually have picked up, but that's the reinvestment risk. When you have money come out of your portfolio and you need to reinvest it, you're reinvesting at a much lower interest rate because interest rates have fallen. So reinvestment risk is worried about interest rates falling. Price risk is worried about interest rates rising. Cash and cash equivalents have very high reinvestment risk, but almost no price risk. Bonds have very different levels of reinvestment and price risk. Short-term bonds have very high reinvestment risk, but very low price risk. Long-term bonds with high duration, they have very low reinvestment risk, very high price risk. I don't know who asked that question, but I hope, does that help some?
Okay, thank you. This is Evander. Thank you.
Evander, yeah. Yeah, Evander, and I don't know what would happen if you were to Google reinvestment risk. I'm not really sure what would come up. It might be interesting to see.
Yeah, I'm gonna do that as well.
Price risk, interest rate risk, that's pretty well set, and we'll definitely be covering that in detail. We're not going to talk about reinvestment risk after this. So what is cash? Cash is usually you loan money, but you loan it for 1 year or less. It's really, really short term. So since it's 1 year or less, you loan it out for say 9 months at 3%. In 9 months, they pay you back, and now interest rates are at 1%. You're kind of upset. You wish you would have loaned it out for 5 years so you can lock in that rate. So, but bonds, and don't say, some students on the exam, they say cash has high reinvestment risk and low price risk. And then they say bonds have low reinvestment risk and high price risk. That's not correct. Bonds have varying levels of reinvestment risk and price risk. Short-term bonds have high reinvestment risk and low price risk. Long-term bonds have low reinvestment risk and high price risk. So don't say the difference is one's low and one's high. With bonds, it depends on what kind of bond you're looking at. Now, if you really want to get into fixed income, you can take John Toohey's class. That would certainly work. He teaches a fixed income class. Or you could get some books. So here's the books. I'm not necessarily recommending you buy this book, but it's certainly be a good book to put into your portfolio. So from that standpoint, you might want to buy it. So let me show it to you. It's a very, very, very famous book. So it's called The Handbook of Fixed Income. Hopefully y'all can all see the screen. We say it's written by Fabozzi, but he didn't have to actually write it. It's edited by him. He may have written a couple of chapters in it. It's a long book. It is, I don't see it yet, but somewhere in here, tell me number of pages. But a lot of pages, over 1,000 pages. It's not a book you would buy and listen to on Audible. It's really more of a textbook. I haven't read it all the way through. I've read chapters, but I haven't read the whole thing through. It's a tough read. It's more of a reference book. It's quite intense as a book. There it is. Oh, my word, it's 2,600 pages. My word, it just keeps getting longer and longer and longer. So if you go to the index, and I know a couple of these guys that wrote this guy, Brinjo. We call him Brinjo. I can't say his name, but he wrote one of the chapters. We called and talked to him about it. So there's some people in here you may run into in your careers. A lot of people. So you can see Frank Fabozzi did not write this book. It's the 8th edition. You could probably get away with buying a more recent edition. We're going to cover a little bit in this book, but you can see on the index, he talks about different types of bonds at a very high level. Look at the first two risks that he mentions, interest rate risk and reinvestment risk. I called it price risk, but it's also known as interest rate risk. We're going to talk about call and prepayment risk. We're going to talk about credit risk. We're going to talk about inflation risk. We're going to talk about liquidity risk. We're going to talk about exchange rate risk. We might even mention a couple of these others. We will mention sector risk. So we are going to cover quite a few of these. He talks about the major indices. What you'll notice as you get into this book, especially the second half, he gets into what we call structured debt and asset-backed debt. And that really dominates the book. We're going to talk about inflation-linked bonds. That's what Brinjo wrote. We're going to talk about emerging market debt. So we're going to cover a lot of the themes in this book. We're going to cover them at a very, very, very high level, though. So, so there's one book. If you don't want to get that into it, there's another book that I do like quite a bit. See if I can find it here. It's a book by Bruce Tuckman that actually does work as a good read on a bike or whatever you're doing. It's called Fixed Income Securities by Bruce Tuckman. I don't know if he's related to Barbara Tuckman, but he's a good writer. His book is much shorter. It's much shorter. It's only, I don't know where the page length was on the other one, but it's much cheaper as well. I think it's 600, 700 pages, if I can remember. It's been a while since I got it, but very, very good book. What I like about his book, he doesn't go quite into the detail Fabozzi does, but what he does do is he talks strategy, and I really like the way he talks strategy. What should you do if you expect interest rates to do this? What do you do if you expect the yield curve to steepen or narrow? Those kind of things. He does a really good job of talking about bullet strategies and barbell strategies and laddered strategies and when you would do one versus the other. He's a very good writer. I don't know his background, but he does write well. Anybody see the number of pages yet? Why can't I ever find that? $640 pages. So this is a book you could buy and, read 4 pages a day and you'd be through it in half a year, or read, 4 pages a day. And a book like this would be pretty tough. This is pretty intense stuff, but it's a book I highly recommend. It's a really, really, really well-written book. There's Fabozzi's book, 9th edition. So, you can buy an older edition and probably be okay and not be missing out too much. Why do I bring up fixed income? I don't think most finance students realize the world of fixed income, how exciting it is. Finance students think equities, stocks. They want to be a stock portfolio manager and all of that kind of stuff. But there's more bonds. There's more money in bonds in the world than there are in stocks. I like bonds. Even though I was head of equities, I actually like bonds more than stocks because bonds have a lot more quantitative to them. There's a lot more math with bonds. There's formulas and stuff that you can work with that you don't have with stocks. Stocks is more of an art than a science. Bonds is much more of a science. And to me, the math is pretty fun. In fact, if you wanted to start your career in fixed income and go back and get a master's in mathematics, you'd be set for life. The lady I worked with at USAA, she ran USA's largest bond fund. She has a PhD in mathematics. Smart lady. She actually called the 2008 crisis perfectly. I wish I had listened to her. Very smart lady, but she has a PhD in math. So you can see on the bond side, math skills really help a lot. Really quite powerful. So if you're a quantitative person and you like more formulas, you like more regressions and that type of analysis, you want something you can really sink into from a quantitative standpoint, bonds is probably going to be a much more interesting world to you than stocks. But you may not choose that. You apply for a job and they hire you and that becomes your career. That's the way it works a lot. Right. But if you really want to do bonds, I've got great contacts at Victory Capital and they are hiring our students and they do bonds. You can certainly get some exposure that way. All right. So there's cash, there's bonds. Stocks or equities, the reason I like the word equities just means you're an owner. So stocks are equities, but so is real estate. We have equity real estate. So not all equities are stocks, but all stocks are equities. So I don't like the word equities, but you have actual ownership. So when we do stocks, we're going to look at beta, capitalization, style, and US versus non-US. And then we have alternatives. Important on your exam, you put those in your answer. Why do we have these other asset classes? And there's two reasons people talk about them. The most important one is diversification. We have these other asset classes because they're going to diversify our portfolio. And then because we're putting real assets in our alternatives, things like real estate and commodities, real assets really help us against inflation. Things like gold and real estate and commodities tend to be a good protection from inflation. Not all alternatives protect you from inflation, but a lot of them do. So what's in alternatives? It just depends on where you work. So we're going to see under stocks, we're going to put emerging markets under stocks. But when I started my career, emerging market stocks were an alternative asset class. They'd not become a company. You remember when we looked at William Sharp and his 12 asset class, he did not have emerging markets there. So today, emerging market stocks is a pretty common part of the stock portfolio. When I started my career, emerging market stocks were part of alternatives. Things like private equity, venture capital, hedge funds. I don't actually consider hedge funds to be an alternative asset class. I consider hedge funds to be an efficient way to get the other asset classes. A hedge fund is an efficient way to get a stock out asset class. We're not going to talk hedge funds too much in here, but I do recommend you Google hedge funds and the most popular hedge fund strategies. So you know what market neutral is, you know what convertible ARB is, you know what distressed debt is, global macro, managed futures. You know what those most popular hedge fund strategies are. Just high level. You don't have to be an expert on them. That'd be something good to know. We don't really cover it in this class. We will talk about private equity and venture capital. So it changes over time because asset classes become more acceptable over time and they move out of alternatives and move up to the appropriate category up above. Right, so there's our 4 asset classes. So very, very careful now. It's extremely important that you have this down, what we're about to do. All right, everybody's paying attention. I can't see you now, so I have no idea. If you were checking Facebook for some reason or whatever, shut it down and listen. Very, very important. We are now going to go into these major asset classes in more detail. And what you need to know, it's going to be a little tough with cash. Cash is unusual. What you need to know is the subcategories of each asset class. You need to know what the characteristics of those sub asset classes are, how they're defined, and you need to know the strategy for those. All right. Let me go to bonds so you know what I'm talking about here. So bonds. Bonds are sub asset classes for bonds. We're going to use the phrase DC cuts I. The D of DC cuts I is duration. All right. So under bonds, we have duration. Duration is a measure of that price risk we talked about earlier. We're going to have 3 subcategories under duration: short term, intermediate term, and long term. And then the strategy is, you expect interest rates to rise, you want to shorten duration. You expect interest rates to fall, you want to lengthen duration. So those are the 3 things. What are the sub asset classes? How do you define them? And then what's the strategy? All right, so we're going to be going that in detail. Cash is unusual in that cash does not have subcategories. Cash is cash. We don't have 5 subcategories under cash. So on bonds, we're going to have DC cuts I. For stocks, we're going to have bucks. For alternatives, we're going to have real assets and then other. But for cash, we don't have subcategories in cash. All right, cash is just cash. It's its own category. So what you have to do here is just talk about examples of cash. So first of all, cash is a loan to corporations, governments that mature in less than a year. It includes things like treasury bills. That's when you loan money to U.S. government on a short-term basis. It includes agency short-term loans. Those are other government agencies you loan money to. It includes short-term loans to corporations. That's called commercial paper. It includes money market accounts like money market checking, money market savings, money market mutual funds, money market demand accounts. That's when you put your money into an account that is buying a bunch of T-bills and commercial paper, and you're sharing in whatever they do. So money market mutual funds, they buy commercial paper, they buy discount notes, they buy other short-term types of things. All right. What's the characteristics of cash you want to bring into? Cash generally has the lowest expected return. We definitely know that's true today. Cash is making you almost nothing. Now, we generally say the risk is low, but we're talking about price risk. We did say that cash has high reinvestment risk, and also cash tends not to do a good job keeping up with inflation. I know that's true today, right? Because we have inflation in the 5% plus range, and cash is still only making you like 0.1%, 0.2%. So today, you know, your cash investments are not covering you for inflation. And you know you have high reinvestment risk because interest rates have been pretty volatile. So the expected risk, we say it's low, but we're really talking about price risk. The duration of cash by definition is almost zero. What does that mean? That means cash is very insensitive. The price of cash is very insensitive to changes in interest rates. Very low price risk. Credit risk, we'll talk about that later. That's one of the C's in DC cut size. Credit risk is generally very, very low. However, in 2008, some of these funds did lose some money because they had made short-term loans to AIG and Lehman Brothers that went under in 2008. I keep forgetting how young most of y'all were in 2008. I keep thinking of it like it was just yesterday because it's, you know, burned on my brain because that was a big year for me. But you guys were probably in elementary school in 2008. But you probably have heard of it and were aware of it at the time. So yeah, there were some cash accounts that lost money, but even the big news stories that lost money, they lost like 1 or 2%. They didn't lose 30, 40%. They lost a small amount. They were well diversified. They did lose a little bit of money because of AIG and Lehman Brothers, but it wasn't huge. The correlation of cash is pretty unstable, but cash tends to do really well in a crisis. Most people like having high quality T-bills or something in a crisis. Because you know you don't have to worry about the stock market crashing 30%. I mean, like I said, in 2008, your worst case scenario with cash is maybe you lose 1 or 2% because of an exposure to Lehman Brothers or something. But even you know that's not horrible in a year like that. Cash is usually held to provide liquidity. So most people don't have cash as part of their strategy. Instead, cash is what they hold when they don't like the markets. They want to hold cash on the sidelines and wait. And they think the stock market, like right now, some people think the stock market's going to keep crashing another 30, 40%. So they just want to sell all their stocks and just hold it in cash, wait for the market to crash, and then they'll get back in. You might have heard the phrase, keep one's powder dry, which just means you don't want to really put yourself at risk until you see how this market works out. And right now is a time where people might actually hold more in cash. But cash is generally very, very liquid. T-bills are generally really liquid, but although I'll tell you a story, which is pretty shocking. You might not find it shocking, but it was shocking to me. I was doing options in 2008 and I had an option mature and we were in the money. So we made like $300 million on the option. So I go over to Donna, who runs the bond fund, the bond portfolio for USAA. And I go, hey, Donna, we're going to have $300 million showing up tomorrow, just letting you know. And Donna says, well, what am I supposed to do with it? I said, well, why don't you just stick it in T-bills? And she said, there are no T-bills. And I thought she was joking. I actually laughed. So what do you mean there are no T-bills? T-bills is the most liquid asset in the world. She said, there are no T-bills. I cannot buy T-bills. Everybody that owns T-bills is refusing to sell them. I cannot buy T-bill anywhere. And she was pretty frustrated. I was sending her $300 million at a time where there was just nothing to buy. And I said, well, sorry about that, but you're getting $300 million tomorrow. Pretty crazy. 2008, we saw stuff we'd never seen before. Pretty crazy that you could not buy a T-bill in 2008 because nobody wanted to, they were just clinging onto them for dear life. But generally, in 99.9% of the time, cash is very, very liquid. You can sell it real quickly and not worry about losing money. All right, that's cash. Any questions on cash? Everybody's good. Can't see y'all anymore, but that's good. All right, so we're about to get into the good stuff. The really good stuff. I'll probably start talking really fast because I get really excited. I love this stuff. But it's complicated, it's difficult. So I'm gonna expose you to some difficult stuff. On the exam, you don't have to be perfect on DC Cuts I. You need to get most of it, but I do want really deep answers, all right? I don't want a 2-line, 2-sentence answer when we talk about duration or convexity. All right, we're gonna be handling some tough stuff. Most professors would say you shouldn't cover convexity undergraduate. Maybe in John Tui's class on fixed income, that's where you cover convexity. I think you can handle it. Previous classes have handled it. It's a great term to know if you get into an interview because you'll sound like a genius. So we're going to cover some tougher topics. But right now, what you need is DC Cuts I. All right. D is for duration. Right. Write it down. You're going to see it in notes, but write it down anyway. Duration. How many of y'all have heard of duration before related to bonds? That sound familiar? David, you have? Anybody else? Jose, have you heard of duration related to the bonds? Or Eric?
No, sir, all this is new material to me.
All right. So if you haven't seen duration, I mentioned it some of my 3013, but not extensively. The second one, convexity. My guess is most of you have not heard of convexity related to bonds. Is that true? Convexity, David, have you heard of convexity? So you got duration, but not convexity. So DC, duration, convexity. The next C is not too bad. It's called credit. That's the risk of bankruptcy. You probably know that. The U of DC Cuts I is US versus non-US bonds. We're going to talk about that. That's where currency comes in. The T is for taxes. Not for Texas, or taxes. There are some bonds that are tax-free. There are some bonds that are taxable. So that's the T. S, which is by far becoming the single most important one, is called structure. That's where finance is going crazy right now. You may have heard of the term financial engineering. Does that sound familiar at all? Finance has found ways to create new bonds that are so crazy wild. And that's why I mentioned Fabozzi's book. You'll discover probably over 1/3 of that book is on structured debt. We're going to spend like 2 minutes on structured debt. All right. So I want to make sure you realize we're just scratching the surface. I remember asking a class once after we finished fixed income, I said on a scale of 1 to 1,000, where do you feel like you are on fixed income? Some students said, I think I'm like a 7. Some says, I think I'm a 12. And I said, well, that's great because I personally, I'm like a 0.0001. There's so much in fixed income. I've had a lot of background on fixed income, especially working with actuaries. I've had enough exposure with fixed income to know I know very, very little about the entire world. It's so massive. There's so many details. Every time I meet with an expert, I'll tell you a story. It's kind of embarrassing, but I'll tell it to you. I went to BlackRock once, and one of their portfolio managers, he's real excited. He had built this new prepayment model to measure convexity of mortgage backs. So he sat down and showed it to me. I had no clue what he was talking about. So he explained it again. I had no clue what he's talking about. So he had a receptionist take me downstairs for cookies and milk. He like rolled his eyes at me like I was the stupidest person on the planet. I felt really stupid at that point. I don't think I'm stupid, but boy, he was covering something that was very advanced mathematics. So why do I emphasize fixed income? On fixed income, It's one area in finance that if you specialize and handle some really complex stuff, you're set for life the rest of your life. You're gonna be making 7 digits, 6 digits, 7 digit salaries. You will have no trouble finding jobs, but you got to get in there and learn that difficult stuff. It might take you 2 or 3 years if you're trying to do certain types of bonds that are really complex. There's a guy, Trey, at USAA. He does CMBS, commercial mortgage-backed securities. He knows them backwards and forwards. If you sat down with him, he could talk to you for hours and hours and hours and tell you about 1% of what he knows. All right. Now, does that scare you or that excite you? I'm hoping it does both. Right?
Exciting.
You do both. But what you want to do in your career is you need to jump in one of those areas and don't look back. And you're so smart that after 2 or 3 years, you're going to know it. And not only are you going to know it, there's only going to be a small fraction of the rest of the world that knows what you know. So now you are highly marketable. You can get any job you want at any pay. You have no risk. I mean, to me, that's what is exciting. What's the hard thing? The hard thing is picking that area of specialization. Isn't that the hardest thing? And a lot of times it's going to pick you rather than you picking it. But if you say, hey, I want to learn one of these structured debts, come talk to me, and we'll figure out what are those firms that do that. And then you might want to interview with a PIMCO or Western Asset Management or BlackRock. BlackRock is famous for these highly quantitative bonds. That's why that guy I was unable to talk to that guy. He had a PhD in math. He was so advanced in his mathematics, he just could not dumb it down to my level. He knew the stuff too well to be able to explain it to me. But you could be that person. And isn't that what you want to be? You want to be that person. So when a finance professor comes to talk to you, he or she doesn't understand a single thing you're saying because you're so advanced in that field. All right. So I'm trying to get you excited about this more than scared about it, but we will cover some stuff that's a little tough. So just be ready for it. So let's talk duration first. We'll just kind of start duration today. So duration, let's start with the definition. So remember, you need a definition. What are we talking about with duration here? Duration is the weighted average time to maturity using discounted cash flows as the weight. That's the technical definition. The non-technical definition is duration is the measure of price risk. The more duration a bond has, the more exposed is to interest rates. So a bond with a 10-year duration is going to fall much more in price than a bond with a 2-year duration if interest rates rise. Okay, so that's the key. There are 3 subcategories: short term, which are low duration bonds, intermediate term, and long term, which are long duration bonds. So long term bonds have very high duration, so they fall a lot in price when interest rates rise. Short term bonds have low duration, so they don't fall nearly as much when interest rates rise. All right. Who came up with these 3 categories? My understanding of the history is that Vanguard, the second largest money manager in the world. Vanguard is the first company to come up with this concept of short term, intermediate term, and long term. You saw that William Sharpe had intermediate term and long term on the bonds, so he thought about it as well. But duration is a concept that came around. It was developed in the 60s and 70s, but it didn't really get known until the 80s and 90s. I was listening to a podcast with Dr. Ibbotson. Dr. Ibbotson came out of college in the 60s, late 60s, and he started managing bonds. And he had studied duration, but the bond world had not learned duration yet. And he said his job was so easy because he understood duration in a world where duration was extremely important, and the people he was competing against did not understand duration. Today, people understand duration. It's very central. I actually saw that transition. Money Magazine did a front page cover story on duration. And so USAA, we started getting all these calls on duration, and the portfolio managers in place didn't know what they're talking about. They had never covered duration. But that was an older generation. The people that replaced them, the younger people that came in and replaced them, they knew duration backwards and forwards. So somewhere in the early 90s, duration went from being a fairly specialized thing to everybody knowing about it. All right. Something else you probably want to put on your exam is this equation right here. So duration gives us an estimate of how sensitive a bond is to interest rates, because we say the percentage change in the price of a bond should equal about minus sign times the bond's duration times the change in yields. Why minus sign? Well, because when interest rates rise, bond prices fall. Time to change in yields. All right. So let's practice it. All right. Let's say you have a bond with a duration of 5 years. You all see that right in the middle. I don't know if y'all can see my cursor or not, but the second sub bullet down. What would this bond be expected to do if interest rates rose 100 basis points? We talked about basis points before. 100 basis points is 1%, which means what if interest rates go from 2% to 3% this year? What would a 5-year duration bond be expected to do? So you do minus sign times its duration. Its duration is +5 times the change in interest rates. Interest rates rose 0.01 minus times +5 times +0.1 gives you -5%. So you have a bond has a 5-year duration, and interest rates for the rise 100 basis points, you would expect that bond price to fall 5%. If the bond's duration was 8 years and interest rates rose 2% or 200 basis points, you would expect that bond price to fall 16%. If interest rates were to fall 200 basis points, that bond price would go up 16%. That's what we saw in 2008. There were long treasuries with 15, 20-year duration, and interest rates fell in 2008. So long treasuries were up 25, 30% in 2008. That's duration. We're going to stop there and we're going to talk strategy. So you got the definition of duration. You got the 3 asset classes. Next up is the strategy. So we'll get into the strategy next. So I'm going to stop it there.